Will anybody in Kentucky take issue with that?
I went to Florida State University, and
We're sorry to hear that.
well, you've got to have somebody on the team that actually has an education.
A trillion here, a trillion there. At this point, it becomes a rounding error.
All right, get on with it.
All right, everybody, welcome to this latest edition of Bugle Notes. I'm Stephen Weitzel, and I'm joined today by my colleagues and my partners, Nolan Giddens and Patrick Hill, our managing partner down in Florida. So, gentlemen, thank you both for being on here today. So today, I want to take some time to be able to introduce both of you to our viewing audience, and we're going to talk a little bit about your backgrounds and how you started in this business. And ultimately, we're going to get to what brought you to Reveille and when you had the moment of recognizing that there's something out there in the future that is going to require you to do something different from the way that you'd always done it before. All right, Nolan, let's start with you. So tell us a little bit about your background. Where'd you grow up and how did you get into our industry?
Sure. Well, first of all, thanks for inviting me and glad to be here for the first time. So and Patrick, I'm not going to throw us under the bus yet, but Patrick and I are the quote unquote old guys, right? So we're the ones that have been around the business for a long time, I guess. So I am in my 35th year of being a financial advisor. I started when I was 5. So no, I started grew up in Atlanta or outside of Atlanta. One of the few people from Atlanta, lived in Atlanta, went to school in Atlanta at Georgia Tech, graduated in 1989, and started in the business literally 3 days after I graduated. So started with a company that is now no longer, has been acquired, I guess, a company called Morgan Keegan, based out of the Southeast, has since been acquired multiple times, but now ultimately residing at Raymond James, which is,
of course, kind of full circle for you, right?
Kind of full circle, right? But have worked for some of the bigger firms, right? Have worked for Merrill Lynch, have worked for Morgan Stanley, have worked for UBS, until I came. Of course, when you and I joined up at Morgan Stanley back 10 plus years ago, and started the kind of the origins or created the origins of what has become Reveille Wealth Management. But been in the business a long time, and have seen a lot, and look forward to being able to tell the Reveille story as it pertains to what we're going to talk about today.
All right, Patrick, tell us a little bit about where you grew up, how you came into the business, and then we'll get into how we all met.
All right, I started. I went to Florida State University, and
we're sorry to hear that.
Well, you've got to have somebody on the team that actually has an education. So, yeah. So I started my first job direct out of college was Merrill Lynch. So I am in my 41st year of being in the financial planning industry.
Wow.
I actually, I spent my first 9 years. I grew up in Augusta, Georgia, so I'm a Georgia boy also. But then we moved to Winter Haven when I was very young, and Winter Haven, Florida, and I've been in Florida ever since. I've actually been an investor since I was 8 years old, when my grandfather took me to meet his local stockbroker. So I've been doing this for a very long time, and I'm a guy who, my hobbies, I don't hunt, I don't golf, I don't fish, but I do read annual reports and I read prospectuses, and I know it seems weird, but that's the kind of thing I've done as a hobby since I've been in this business, which, if you got to have a hobby in the financial planning industry, it's a pretty good hobby to have. I brought my son Christopher into the business with me a little over 10 years ago. He's on Reveille's investment committee, and we work hand to hand together here. With the offices based out of Ocala, Florida, which for those of you who don't know, Ocala is the thoroughbred horse capital of the world.
That's right. Will anybody in Kentucky take issue with that?
Zero question. They would tell you that they are the horse capital of the world. We would simply argue with them, or let's just say debate.
Okay. All right. Well, one thing is I just want to touch on real quick, Patrick. I know that so even though your origin story begins a little before mine, that your entry into this business, I believe, or you spent time in the early days of your career with a company that would become the company where I started my career. And that was when you were with Barnett Bank.
Correct. Yeah.
Yeah. Just tell us a little bit about that.
I started in '84 with Merrill Lynch, and frankly, I wasn't a great fit at Merrill for a few reasons. But I was the first hire. Barnett Bank was at the time Florida, and this would have been 1989. Barnett was Florida's largest bank, and they were starting a true financial planning company. They had a bond company, but they were starting a financial planning company. And I was the first hire of Barnett Securities. I was the first guy they hired for that. And I thought it was a fantastic bank, but the world changed. They ended up getting bought out or taken over by NCNB, which eventually became Bank of America. Is where Merrill Lynch is housed today. So that full circle, right? They all seems like they all come back together. I eventually ended up at Raymond James as an independent, opened an independent financial planning firm in May of 2000. And so I had been independent, working through Raymond James, the office here in Ocala, until I met Nolan. When was that? 3 years ago, Nolan, that I met you?
Yeah, I think that's right.
Yeah, a little over 3 years ago, and that changed the trajectory of my career.
Well, so let's talk a little bit about the time that both of you guys have spent in the industry and working with clients and advising clients, that you've seen economic booms and busts. And so I want us to just recount a couple of those stories about how you were working with clients during so Patrick, I mean, you could talk about being there for the crash of '87. Both of you could talk about being there during the .com boom, the boom and the bust, being there during the financial crisis, which would have been the earlier days of my career. But let's talk about that a little bit. Patrick, what do you remember about the crash of '87? Well, what was going on in your world at that time?
Yeah, interestingly, I was the day of the crash. I had just gotten back to the office from Christopher being born.
Okay.
I was there the day that it happened. I remember again, we're going back to 1987. People were scared to death. It was a 20% plus drop in a single day.
Yeah.
We had never experienced, even during the Great Depression, you didn't have a single day drop like that. So I was in the industry for this. I can tell you that Wall Street was in a panic. Main Street was in a panic. I personally knew clients. I knew a stockbroker at the time who ran to the banks to get cash out, right?
Mm.
Because they thought it was the end of the world. I of course never believed that. And so it was a time of panic. Our job at the time was to hold hands and to keep people from panicking. That's literally what the job was on that day. And it is interesting. One of the big complaints. So being in the industry since 1984, I've been through every economic turmoil since then. And it does change your view on the way you manage money when you've been kicked in the teeth 10, 15 times every time there's a correction, on some level.
Yep.
And I think that's what makes experience so important, because until you've been through it, until you've experienced some of these massive corrections that can wipe out decades, in some cases, worth of returns,
Yep.
you don't actually get it, right? You can read every book, you can read every regulation, you can understand strategies, but until you've lived through them, you just don't have the wisdom or the understanding of what it's like.
Yeah, and I feel like a lot of people these days, they seem to have short memories, and I don't know if it's just the internet and the social media that we have today, where everybody seems to have a short memory. They can't, they don't really remember what even happened a couple years ago. But
Yeah, Stephen, I would push back a little bit. People have always had short memories, right? Because
okay,
you can go through. I've been through these events with clients, and it is amazing, right? You can talk about risk and the amount of volatility in a portfolio, and they're still going to be your client might still be standing on a golf course somewhere discussing, hey, I outperformed what your guy did, or my portfolio did better than your portfolio, with no discussion of how much risk that one golfer has taken versus the other. People tend to focus on returns and kind of fog out or forget about the damage done to their portfolios in the past. So we're all very what's happening today, right, as opposed to what happened in the past.
yeah. Nolan, give us a couple of your stories in terms of working with clients through some of these economic boom and bust cycles, and the way that you were trying to give clients advice and guidance through those periods of time.
Sure. My first really volatile time in the market. So, I started in 1989, really after the crash, the mini crash of late 89. So really didn't have a whole lot of bad things happen. I do remember specifically, the whole point of or the whole time in 1994, which was awful. I guess it doesn't warrant mentioning as much as the dot-com bubble or the great financial crisis, what have you. But 94 was an awful time, especially to be a buy and holder, as as we had been trained, so to speak, in the industry, which was just diversify, modern portfolio theory, right? Diversify, buy, hold, rebalance on a regular basis. But 94 comes rolling through, and it was ugly. I mean, it just seemed like it was straight down during the course of that whole year. So that was not a whole lot of fun, but that planted the seeds, along with the dot-com bubble, which basically the same thing happened 5 to 7 years later. Markets do very, very well, and in particular, in the dot-com bubble, the technology stocks, does that sound familiar, by the way? Anyway, they rally tremendously during that time period, and then it comes all crashing down over a 18-month 2-year time frame. And it kind of made you helpless as a financial advisor with a traditional buy and hold strategy, and that being the mantra that you had adopted to your clients, was just hang in there, ride it out. And once again, that planted the seeds for another time, right? It comes along another 7 or 8 years later with the great financial crisis, and that's the one that really got me going to do something differently. So I'll tell you a little anecdotal story real quick. So I'm with Merrill Lynch back in 2007. The market has done well, right, following the rebound of the dot-com bubble in 2002. Basically, is where it kind of bottomed out. So it comes back, and so the market reaches an all-time high again. I guess it was maybe late
October,
October, right, 07, something like that. And so I'm having a client review with one of my clients, and at that time the market's once again at an all-time high. And he looks at me and he says, I want to go to cash, or I want to, I'm going to get ultra conservative right now. The market's done well. I want to go to cash. Want to do something to preserve these gains. And of course, our industry, and in particular the company I worked for at the time, right? The answer to the clients, well, you can't do that, right? Because you can't time the market. You don't know what the market's going to do over the near future, and just because it's at an all-time high, it could go substantially higher. You can't just guess.
Well, and of course,
figure out.
at the time, and Patrick chime in on this, but so those are the early days of my career. There were some rumblings already about how maybe there was some trouble on the horizon as it related to the housing market, but the Fed was adamantly against any of that negative news, and they talked about how defaults are regional, or defaults are low, slowdowns regional, and this is not a systemic issue, and we're going to power through this. And the industry would always try to tell you, well, if you were going to come out, that you got to time it right twice. You got to be able to sell at the right time, and then you got to buy at the right time. And so just the conventional industry advice would be, no, you can't come out of the market, right? Because you just got to stay in.
Well, and then you always have the quintessential answer to that the industry has, which is the markets always climb a wall of worry, right? So it doesn't matter what today's issue is, the market's going to be higher somewhere down the road. Well, we've also kind of have an answer for that here at Reveille about the reason the industry adopts that type of attitude, as we mentioned, is because the time horizon for the industry is infinity, right? So they're all going to be around long after you and I are gone. So they all come back down to, well, you can't time the market, right? You can't figure this out. So let me go back to this client. So it's October 2007, right? And the guy says, I want to go to the sidelines. And of course, I talked to him and using the industry training that I have, right? We can't do that. It's just not advisable. And so he acquiesces, right? And we don't do anything. So let's flash forward about 18 months, right? So it's March of 2009. We know what happened right during the latter part of 07, all during 08, and then the early part of 09. Sitting back down with the same client at that time period, the markets were down, I guess, from peak to valley. I guess technically the S&P went down over 50%, right, from peak to valley.
I think it fell like 56% or something, peak to trough at that point.
Right. Now, and so the guy just kind of looks at me at this point, and he goes, "Why didn't we do anything?" And I'll be the first to admit that there's silence, right? I mean, what are you going to say to a client at that point? Now, using the traditional industry tools, then yeah, there is no great answer to the client for that. Now we'll get into
because it's not as if you didn't have that guy diversified, asset allocated, right? You've done all that, but it's still in that type of a storm. It doesn't give you the protection that you want, because pretty much everything in those periods of time is going down.
Right. And even though he was diversified, and we talked about the S&P being down 56 or whatever. Now, obviously he wasn't down that much because he was diversified and had some fixed income exposure as well. So, but still down substantially. And I think Patrick made a comment earlier, losing enough money on paper, potentially decades or a long time total return, right? Of having to recover. And then of course
Sure.
we all know the math, right? You go down 50, you gotta go back up 100 just to get back to break even. So once again, it was kind of the epiphany that I had in the industry, or in my career rather, to say there has got to be a better solution. And once again, we'll expound on that here, I'm sure, in a little bit. But it's no fun. And so you want to be able to have an answer for a client other than what our industry tells you, which is just kind of hope and pray. And that, to me, what do they say? Hope is not a strategy.
Yeah. Well, and so to that end, that you had that epiphany at that moment that for your clients that were looking to you and trusting you, that you're doing what you believe is the best thing for them, that you kind of got to the point where you're saying that that the conventional solutions of just diversifying and asset allocating, that's not sufficient for you to be able to do for them what you want. And that's why RBID, our rules-based investment strategy that can be adaptable to these different conditions, was something that you were, when it was first being put together, that you were saying, I'm going to leave behind everything that the industry trained me to do, knowing that this is a better path forward. And that's what I want to do for my clients. So the next time we go through one of these types of market events, that you don't want to be back in the same seat where your client is looking at you going, why didn't we do anything?
Absolutely.
Yeah, and let me jump in here for a second.
Yeah, go ahead.
Because by the time the dot-com bubble came around, I had been kicked in the teeth enough by bad events in the market that I knew what was coming. I mean, you couldn't look at the earnings that simply weren't there in the dot-com stocks and look at the valuations on those companies and know that there wasn't a significant problem coming. And again, I've been brought up on that model, on modern portfolio theory, which is, by God, you hold through the storm, right? You ride it out, because to experience the upside, you have to experience the downside with it, and that you're protected by two things, right? Diversification, asset allocation, and time. You give it time and you'll come back. And that leaves a lot on the table when you've been through some of these experiences that it takes you 5 or 6 years just to break even. So rolling into the dot-com bubble, we were scared. And I say scared, me and my partner at the time, Thad Kopech, we were scared of what was coming and made some decisions to move. In my case, I moved 50% I tried to get all of my clients to move half of their money out of equities into fixed income. And my partner Thad, he got actually asked everybody to get 100% out of markets. And you know what? We were ultimately absolutely right to do that, to go to the sideline because of what was coming. And at the same time, we were absolutely wrong, because we both got out too early, right? We didn't have a system. Our system was diversification, 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 get really great managers, and then ride out the storm. Well, because we really thought we were in for a hard time in America, we went to the sideline. But do you know when that was? That started in July of 2008. We missed one of the biggest up moves in the market of my career. That 1999 market was spectacular. And half of my money sat on the sidelines. At least it was in cash at the time. We were earning something, but we missed a really large run up in the market. And even though we were ultimately proved correct, it's those two moves, right? When do you get out and when do you get in? So already after that experience, I didn't believe in timing, but I know I didn't believe at all in the buy and hold philosophy, because I watched people lose money. I watched myself lose money. I watched my clients lose money. And so I had been looking a long time for a better way to manage a portfolio. And I'll also go back to this. Nolan, when you first started in the business and I first started in the business, it was a commission-based business, right? You had to make a transaction to generate an income stream. And starting in about 2000, 2005, the industry started converting to fee-based. And so that you didn't actually have to do a transaction to make money. You got paid for managing funds, getting on the same side as the client. But even that creates some, let's say, human nature issues, where if you think, hey, the market looks scary, we should go to the sideline. But if I move too much money to cash, which the industry doesn't like you to do, if I move too much money to cash, I'm not going to get paid. And
Yeah,
so
we talked about that some in one of our other podcasts where we were kind of peeling back the layers of the onion, right, in terms of what your financial advisor doesn't want you to know.
right. And it's not that you don't try, right? I mean, I truly don't believe there's ever been a point in my career, not one time do I believe I've ever sold or bought something for a commission. Have I ever bought or sold something because of, hey, if I go to cash, I'm not getting paid. But I'm going to tell you, it's always there, right? That because it's human nature. And if you don't think it impacts a large swath of the industry, not to go to cash when perhaps they think you should, I think we're just fooling ourselves, because I truly believe that happens. It's one of the reasons that I was so struck when I first saw the Reveille system is it eliminates that human nature component completely.
Yeah.
And so we all fight it. If we're good at what we do and we're honorable, we fight that human instinct. But our system really just eliminates that completely, which is, in my opinion, vastly superior to what the rest of the industry is doing.
Yeah. So Patrick, let me ask you this. So, that we're at a point in time now where you, like a lot of other folks out there, that are of retirement age or nearing retirement, they've got concerns about the future path of our country, of our economy, the trajectory that we're going to be on. And while, at Reveille, we don't make forecasts and predictions about where the market's going, and that's the beauty of RBID, that we're merely aligning with market trends. It doesn't matter what our opinion is, but your thought is that we have the potential for some real calamity on the horizon, and it's things that are right in front of us, that are in plain sight, where the government even gives us the data on that information. And so I want you to kind of tell us, what is it that you're seeing that concerns you the most? And then, to the extent that these concerns become our reality, what do investors need to do to be able to protect themselves? And then, do they have any opportunity to take advantage of that environment?
Okay. Well, I already mentioned that I read annual reports, always have. I read prospectuses. I'm always looking at something about the economy. It's just something that I study. 13 years ago, actually, I guess a little longer than that at this point, I came across I was actually in Washington when I came across it on a trip, and I had somebody tell me about the financial report of the United States government. And I didn't know that the United States government put out a financial report. So I thought, oh, that'll be interesting. So I actually contacted I didn't have internet access to this information at the time. So I contacted the Library of Congress and had them send me the booklet. I still have it. And since that time, I've been studying America's financial report. In my opinion, it's the most critical document that America produces on an annual basis. And a lot of times I'll read these documents because, hey, they're really good at putting you to sleep. If you're tired, they'll cure insomnia. And I actually started reading. I still remember I started reading it at about 9 o'clock at night, and I put it down somewhere around 1 or 2, and I couldn't sleep because the information that's in there is scary. And it's not my information. It's coming from the U.S. Treasury. and they have a specific chapter that discusses the sustainability of the American financial system. And I'm reading where our government is saying it's not sustainable, and here are the reasons why, and here's the trajectory. So since 2000, basically in 11, I have been reading this document every year, not looking forward to it, but dreading it, reading it every year, and this growing fear inside me of what this country has coming. And if you look at the map, it's not conspiracy theory, it's not some 100-year cycle, it's math. And when you look at the map and you stare at the trajectories that I'm not making up, that the government is giving me, it's frankly terrifying. And it doesn't mean it's the end of the world. It doesn't mean it's the end of the American experiment. It just means we are going to have, my opinion, we are going to have a severe economic reckoning. And if you are in a system of money management where we ride out a storm, there will not be any riding out this storm, in my opinion. It will be devastating. And it's my opinion. I don't know the timing of it, but everything in the math tells me that it's coming. And I've been on this trajectory for years, looking at this, saying it's coming, and I've been predicting to my clients that it's coming between that 2028, 2032 time period. And it's only now that the media is starting to talk about it. It's only now that we're starting to hear about America's debt crisis. Matter of fact, I do a presentation, Stephen, that's called America's Debt Crisis. Be prepared, it's worse than you think. And I go around to basically business owners and leaders and give a presentation about things they can do with their businesses to be prepared for this financial storm, and with their portfolios about how they should be prepared for the storm. Because the whole thing is, if you're prepared for what's coming, if you're in a good position with either your business or your personal assets, this storm becomes an opportunity and instead of just destructive. I mean, it'll be an opportunity for all of us to first survive the storm financially, and then second, thrive in its aftermath.
Yeah. So I would say two things. First of all, I think a lot of people, again, share your sentiments about how the writing is on the wall. When you've got $35 trillion in national debt with trillion plus fiscal deficits.
It's 42 trillion, but who's counting?
That's right. I mean, a trillion here, trillion there. At this point, it becomes a rounding error, unfortunately. But that people, I think most people, they say eventually there has to be some sort of a consequence for this. You can't do it without any sort of blowback, and they recognize that. But it's such a large problem, they don't know how it gets addressed, what the potential implications are for them. But I juxtapose that with this idea that right now, and for a number of years now, that America's stock market, at least, has been the envy of the world. And very few people see how that can change, that people have been convinced through many consecutive years of the U.S. stock market doing well, at least the headline indices like the S&P or the NASDAQ, that we are either immune to problems, maybe it's this wall of worry that Nolan has mentioned, and they don't see any reason how it could be something other than that, how it could sour. They don't see it.
Yeah, most investors are confused, right? Because on the surface, our economy seems pretty good. Our interest rates are moderating. Inflation seems to be slowing down. Stock markets, at least, as you said, the major index, the S&P is at or near an all-time high, depending on when you look. Hey, good times. But But most of us feel, and I think most investors feel that something's not right. Something's not right with the financial system. I believe our economy is in party mode, but it's a debt party, right? It's a spending party. It's government spending money that we don't have is the reason this all feels so good. But this party, it's built upon a mountain of sovereign debt, and eventually that bill's coming due, and it's going to be extremely expensive. When we go back to the Great Recession, right, that was an economic reckoning of a housing bubble. I mean, that was the primary driver. I think we all can agree upon that. And we knew for years, man, we looked at it and we felt like, boy, the loans are out of hand, the prices are out of hand, the economics aren't there, and they kept going and going. Matter of fact, one of the big changes in my career was attending a Christmas party where I heard everybody tell me, not everybody, but Indian chiefs and attorneys and heck, other financial advisors telling me you can't lose money in real estate. And me believing, do you guys live in Florida? Because I've been through some economic cycles where real estate got wiped out, but all the signs were there. And everybody kind of felt like, boy, this is getting overvalued, but nobody did anything about it because we all think the party's going to continue. And
Yep.
eventually they don't. And the destruction, so it can go a whole lot higher than we ever anticipate. Prices can get higher, markets can get higher. But when they fall, when they correct, they can correct well beyond just a simple correction. It can go beyond where it should be to bargain basement prices. But if
Yeah.
nobody has any cash during those,
So I will make one comment here as far as we're in an election season right now. There's been absolutely zero fiscal accountability in Washington for a long, long time. And no political party can say, hey, well, we're the party of fiscal discipline. No, we're the party of fiscal discipline. They all get up there and they spend money that's not theirs, like a bunch of drunken sailors. But because at least over the last couple of years that, whether it was post-COVID, you had a lot of stimulus from when we hit the off switch on the economy to Inflation Reduction Act or whatever it was that the Biden administration put out, where there's been trillions of dollars of additional government spending that has likely buoyed the U.S. economic numbers, that anybody who comes into office at this point in time that has a little more fiscal discipline, if the federal government decides not to run a $2 trillion fiscal deficit, but if they just ran a $1 trillion fiscal deficit or a $500 billion fiscal deficit, that level of fiscal drag is probably enough to move the economic numbers into recession, because it's a big change in the level of government spending. And so it seems like whomever comes in, that they're set up for a lot of headwinds in terms of how the economy is going to perform. But I wanted to ask you is what are some of the potential consequences that you would foresee that come out of this sovereign debt crisis, the fact that we have all this debt, and eventually we have to address it? What are some of the ramifications?
yeah, well, there is a prevailing belief, or perhaps wishful thinking, that our politicians can just continue to ignore the debt issue and kick that financial can down the road. What Americans should be asking is, when will our debt levels become unsafe? And heck, I want to tell you that my belief is we are well beyond safe levels. We're already dangerous. If we talk about what are some of the possible consequences of an American sovereign debt crisis, well, first of all, it doesn't stay in America. Whatever crisis we have will spread worldwide. So I think we could easily expect a U.S. currency devaluation, inflation, worldwide equity turmoil, rapid increases in treasury yields, spike in borrowing costs, of course, which means significant losses for bondholders. Austerity measures by our government as if we get into areas of forced spending cuts, all of which can be recessionary. Again, a severe economic recession, not something minor, something that I believe would be worse than anything we've seen in any of our lifetimes, certainly within my lifetime. And if you haven't noticed, I'm old, right? I've been doing this a long time.
The interesting thing is the things that you just described are the types of actions that we've seen in other instances where the IMF, the International Monetary Fund, will go into third world countries when they're experiencing economic struggles. They go in to try to revive their economy, and all of a sudden they're dictating to them, well, your spending's got to come way down, right? We're going to loan you some money to kind of bridge you through, but if we're going to do it, you've got to commit to these very austere types of spending cuts. And it's a tough road out, right? I mean, I think one of the last countries that, has done this was like maybe Argentina. Greece was doing it. It's kind of shocking to think that we would end up in the same position, as them. I mean, that's quite a fall from grace.
Yeah, and I could ask Nolan this, right? But when you see extensive financial damage globally, Greece impacts American markets a little bit, right? You get a little bit when Europe performs poorly, that can impact us. But when American performs poorly, it impacts the world. But I think we've seen some of this recently. I mean, just going back to 22.
Well, I mean, yeah, you saw across the board. Well, I don't know if you call it carnage, but right. I mean, it was ugly in 22 across the board. Did it? You never know what factor drives something else, right? What comes first, the chicken or the egg, right? Whether it's fixed income markets breaking down, does that make the equity markets break down? As you just said, does domestic create problems internationally? Is it vice versa? I mean, you never know. You just know that there's a contagion, and as we saw in 2022, right? When the contagion starts and it becomes across the board negative returns like we've never seen before, of course, in 22, where we
when
had
you say across the board, just specifically, what do you mean by that?
Yeah, I mean, both equity and fixed income, right? I mean, historically, right, you always had, you had bonds where our fixed income was a counterbalance to equities. I mean, the inversely correlated type of moves, but in 2022, we saw that they all became correlated. And we had, of course, the worst year in the bond market ever to go along with a bad year in the stock market. Of course, not the worst year ever in the stock market. But then you saw that carry on into, like I said, into all asset classes, whether it was or all segments of asset classes. Like I said, whether it was large cap, small cap, mid cap, commodities, real estate, fixed income. I mean, everything went down, and that diversification that you would normally get, or the diversification that our industry is recommending, all of a sudden doesn't help so much. It doesn't work as well as you would like it to, and consequently, I mean, that's why sometimes it just makes sense to move to the sidelines, as we've said ad nauseum.
Yeah, absolutely. Yeah, when both sides of the ledger are going down, that's a no bueno type of situation. Well, it sounds like, and again, not that we're making any sort of prediction of what exactly is to come, but and I know that Patrick's got a lot of data on this that he can share, and so if anybody's interested in seeing the fullness of his presentation, certainly reach out send us an email, info@reveillewealth.com, or reach out to Patrick directly, patrick.hill@reveillewealth.com, and we'll be more than happy to bring that presentation to you and share it with you. But if these events that we know are on our doorstep, if they have the type of economic impact that, Patrick, you believe that they'll have, that many others believe that they could have, then it's going to lead to an economic cycle and into an environment that is something like we've never seen before.
Yeah, and I don't believe investors are ready. I don't believe businesses are ready. We hear about the debt, but people don't understand how, $42 trillion is a number that people simply cannot comprehend, right? But know this, 42 trillion, you can take the gross domestic product of China, of Germany, of Japan, of India, of the United Kingdom, France, Canada, and Italy. That's the next 9 largest GDPs in the world behind America. And our debt level is more than their combined GDPs. I mean, it's a serious issue that can lead to serious problems. And if your investment portfolio isn't prepared, if the goal is to ride out that storm, then I wish you luck, because I personally don't believe that that's a storm worth riding, right? What Reveille does by having the ability, or the goal at least, to get us out early in the storm could be what saves our clients.
Yeah, that's right. And but again, I mean, it sounds like what could potentially be on the horizon is something that is not only going to impact all businesses, the economy very broadly, but our industry could largely get turned on its head. And that people that are doing things the conventional way, as Nolan kind of described, 2022 would have just been a first shot across the bow in terms of those conventional strategies failed on both fronts, and that's just a sign of things potentially to come.
Right.
So,
well, I agree completely.
Well, listen, gentlemen, I appreciate both of you joining us here today for this episode of Bugle Notes. Not that I want to say that we bring bad news, but that I think that a lot of people out there, they recognize that the numbers are at a point where they don't make sense, and they're troubled by them, and they want to know, what is all this going to add up to? What does it mean for me and my family? And what do I need to do to protect my family? And both of you have been in the industry for a long time. You've seen other severe economic downturns. This one may end up dwarfing those prior downturns, but you both have recognized that when we go into the next one, you don't want to go through it the way that you had done previously, when it was just more of a conventional approach in terms of being able to protect your clients through that. So again, I appreciate both of you joining here today. So for Patrick Hill and Nolan Giddens, I'm Stephen Weitzel saying thanks for tuning in, and we will see you next time.